Hello everyone, my name is Sunday. You are welcome to Igeinsfx. I welcome you all to Igeinsfx. Guys, how are we progressing? All right. The program has been on since the beginning of this month, and as we all know, it's a free course. I'm not charging you guys for anything. All right, because it's very sad because when you want to get yourself involved in anything and financially you are held back, it's very, very sad. So I have the knowledge and I feel I should just use this to help those out there who are, aspiring to become a forex trader. Forex trading is a skill set. Don't let anybody deceive you. Don't let anybody tell you anything. Forex, if you know the importance of Forex, you will know that that is what rules the world. All right? It's foreign exchange. That is just a short definition of Forex. Foreign exchange. You exchange your country currency to another foreign currency when you want to do business. It happens every day. People who does international business, that is what they do. You exchange one currency to another currency for you to be able to buy from that country. All right. Even if everything shut down today, let's take for example, during COVID, people were still making money. You just sit at home, do your thing. So we don't know what will happen in the future again. Something similar might happen. Somebody will say you are praying for bad things. No, as good things are available, bad things too are available as a man or as human. There are some time in our life that we'll get sick. It's normal, it's natural. All right, nobody pray for sickness, but when your body is weak, you are sick, you need to treat yourself. All right, that is why you need to indulge or rather involve yourself in doing exercise. It's very important if you want to live long because our human organs needs to be exercised. All right? I'm not talking about you going to work. That is not an exercise. It's still an exercise, but when you want to do exercise, you know that, okay, you want to do exercise. It's different from you going to work. All right, that being said, today is day 17 of September. We've really gone far. And I've loaded you guys with enough materials. All you just need to do is subscribe to my YouTube channel, Igeinsfx. That is the YouTube name. Please subscribe. That is the only thing you can do for me. This thing I'm sharing with you, go to anywhere in the world, is the same thing. Maybe because you are getting it for free and you are taking it for granted, well, you are just shooting yourself in the leg. I'm telling you, somebody will package this course, all right, and sell it to you $1,000 and you will pay. And at the end of the day, the person will not even have time to even explain to you like this. All right? He will just go through it, and if you understand, that is your headache. If you don't, that is your cup of tea. But me, I'm here giving it to you for free. And I take my time. I take my time to explain. And I'm giving you guys room. Anything you don't know, any video on any topic that you have watched, you have studied, and you are having difficulties with it, just just give me the topic, all right? Just let me know the topic you're having issues with at the comment section, or you send me a mail, igeinsfx@gmail.com. All right, it's very, very simple. Send me a mail, I will address it. And if it will warrant me to make another backup video to throw more light on where you are having issues, I will gladly do that. The only thing I want you to do for me in return is for you to subscribe, all right? Haven't done that, share my videos. Because you never can tell, you will never know. Somebody out there is just praying to have this kind of opportunity, all right? Please share the video, your platform, share it to your loved one, your brothers, your sisters. Trading is not meant for men, both men and women. Even as a matter of fact, housewives, they are the one that's supposed to be trading, because you're at home with your children, your kids. All you need to do is do your top-down analysis and put an alarm. Once price get to that level, it will trigger the alarm. Then you just go look for your system and place your trade. Or you can set pending orders. Set a pending order after your analysis, send a pending order. Once price get to that pending order, it will trigger it and you will be in the trade. You just be at the comfort of your home and be getting income. As simple as that. You don't even need to go out of your house. All right, guys, so please, I want you to share this video, subscribe to my YouTube channel, and one thing, please activate the bell sign, because once you do that, any video I release, you'll be the first to be notified. That is the advantage. All right? And where you find all these videos, these free course videos that I'm making, all right, you go to my YouTube channel, then you now click on playlist, because I don't want you to struggle to be scouting for videos. No, because I have so many videos. Then I now created a playlist called Beginners Free Course. Beginners Free Course. All right, that is the playlist. Let me put it here. The playlist. So this is where you find all the videos. Beginners Free Course. Beginners Free Course. Okay, that being said, please, today we are going to be treating a topic that is very, very important, very, very key to trading. All right? Apart from you learning how to perform top-down analysis, and you are able to read your structure, that is market structure, all right? The next thing you need to know how to do, that is, you must, because you must know how to read market structure. You must also know how to do or perform your top-down analysis, because if you don't know how to do that, how will you be able to make trading decisions? So you must know how to perform top-down analysis. Starting from the higher time frame, mark your structure, know where the direction of trend is going. If it's bullish, you know. If it's bearish, you know. Mark your break of structure, mark your support and resistance, the levels. Then you now scale down to your time of execution, where you normally place your trade, either buy or sell. All right? And I have told you guys, don't go below 1 hour. Don't go below 1 hour because you need to avoid noise, unnecessary excitement. Trade with a dormant trend. That is how you enjoy trading. All right? It takes time for it to form. All right, for your setup to form, it takes time on a higher time frame. Yes, that is the patience you need to have for you to stay disciplined. Instead of, oh, I want to trade. No, trading is not like that. Trading is not like that. If you want to enjoy trading, for you not to enjoy yourself emotionally, all right? If you want to enjoy trading, all you need to do is stay on the higher time frame, because that is where the hedge funds, the banks, the big boys, financial institutions, that is where they trade. You trade with them. Follow their footprints, their footsteps, not those retail traders that are packed on the lower time frame. No, there are too much noise there on the lower time frame. Don't go there. As a beginner, I'm advising you, don't even learn with lower time frame. Come up direct and do the real thing. You might not have the opportunity to trade one day, second day, maybe in a week. You might have a setup, just one trade. And once you once you see your setup and you enter the trade, allow it to run. If it takes 3 days to get to your TP, allow it to run. It will surely move to your TP. That is how to trade. And only one trade, you are okay for maybe for 2 weeks, 3 weeks, 1 month, you are okay. But you will still see another setup. But once you're able to hit your TP, you are okay. That is how to trade. Trading requires patience, guys. It requires patience. You don't open your chart every day and believe you want to see a setup. No, it does not happen. It does not work that way. If you go to lower time frame, you just be seeing different set of fake setup here and there. And you enter bush, it push you out. Enter again, push you out. All these are rubbish. And of which, on the higher time frame, the big boys, they are not ready yet. They are just arranging, putting their orders, locking in their order, pushing the market up, pushing it down, pushing the market up, pushing it down, creating that zigzag structure, that is a consolidation. They are locking in their order. But once they start to move, you will see it on the higher time frame. Because the lower time frame must come to align with the higher time frame. Don't worry. Maybe the next topic I will teach you guys time frame correlation. All right? I will teach you guys time frame correlation. It's part of the list. All right? It's part of the what we are going to teach, but let's see what happens. Maybe the next video, that is what I'm going to teach. But what the essence of this is for you to know that whatever is happening on the lower time frame, until it aligns with the higher time frame, there will be no movement. There will be no significant movement. If I say there will be no movement, no. There will be no significant movement. Price on the lower time frame will just be going up and down, up and down, up and down. until it aligns with the higher time frame. That is when you now see a significant movement to where price is supposed to get to before pull back again. That is how it is, guys. So that being said, today, like I said, we are going to be treating the topic that is very, very essential, which is risk management. Risk management. That is what most people are lacking. You don't just see maybe a bullish candle, you just click buy, bam, because you see a bullish candle. You just click bam. You don't even know, you don't even know your account size. Yes, you know. You don't even know your lot size. You just type in any lot size, bam. You don't even know the cost per trade. You don't even know the number of pips you are supposed to use and all that. You don't know that all those things are very, very important. Very, very, very important. And before we go further, these are the things you need to put into consideration before you you even say you want to click buy or sell. Number one, that is your account size is very, very important. You must know your account size. Number two, you must know your lot size. And number three, cost per trade. Cost per trade, you must know the cost per trade. All right? Your cost per trade is very important. You must know. Then the fourth one is number of pips, number of your SL pips. You must know that. Your stop loss pip. All right? You must know your stop loss pip. You must put all these things into consideration before you make any decision. You must put these things into consideration before you make any trading decision. Your account size, that is your capital, what you have in your account, in your trading account. Your lot size, which lot size do you want to use? Then the cost per trade. Each trade has a cost. Each trade has a cost. Then your stop loss pip, because each pip has a cost. Each pip has a cost. So you should know, and it depends on the asset you are trading. Guys, let us have this in our mind as a trader. It's not all about you getting in there and clicking buy or sell. No, you must know that this is more than that. Trading is more than just clicking buy or sell. You need to have the education, and that is what we are doing to you now, so that you will learn, have the skill. All right? Focus on the process first, not even the outcome, not the money as the monetary aspect. Focus on the process. You must learn this. Because for you to be a lawyer, you must acquire the knowledge. Plus, you now practice. As you now practice, you are gaining more knowledge. As you are practicing, you are gaining more knowledge. Same thing with trading. Get the knowledge. Then we have a demo account that I've already told you guys to create. Create that account. Your broker will fund your account for you. You will not be able to withdraw that money. It's not for you. That money is for you to practice. All right? After you have acquired this knowledge, then you now use your demo account to start practicing. When you are now comfortable with what you are doing, what you have learned, and you now see, okay, you now have better idea as you keep practicing what you have learned, all right, putting them into practice, you can now open your own account that you will now put money. When you now put money into it, your target now is how do I now grow this money from X amount to this amount? And by doing that, you don't want to just take your two legs at a time. When you want to walk, you take one leg at a time, or rather, you take one step at a time. That is why you need to apply this, what we call risk management. Otherwise, if you want to take your two legs or two steps at a time, you just blow your account and you say, oh, trading is not good, trading is not good. Did you apply proper risk management? The answer is no. Most traders don't even do that. Once they just open their chart, emotions will just come in, and the next thing is both. They will just be clicking buy and sell, jumping in, jumping out, destroying their account, your capital, your hard-earned money. You don't do that. And you now go back and say trading is not good. Who told you trading is not good? Which business can you do that is better than trading? And if they even give you a physical business to do, there are principles that you need to follow before you can be profitable. Even if owning a shop, there are rules, principles, guiding principles you need to follow. Otherwise, you will be making losses, or even if you are making gain, you will even be eating it. You won't even know. You think, oh, it's my own. You just dip in and take money, go and buy beer or go and buy anything. You say it's my money. You are eating your capital. So it's the same thing. So that being said, you must know your account size, your lot size, cost per trade, and stop loss speed. Very important. Then let us go to the slides so that I can show you guys what risk management is really all about. All right. Okay, let's put this guy here. Now, when we say risk management, can you guys see my screen, please? If you can see my screen, just type yes on the comment section. Just type yes, okay? And if everything is bold and clear, just type yes. And if you have been following this course from the beginning, please just type your name and where you are following from. I want you to tell me the country you are following me from and your name. All right. Tell me your name, where you have been following me from, and when you started trading. All right. So as simple, your name and where you are following me from. If you're from the UK, just say, my name is this from the UK. It's okay. All right. And just tell me, how is it going? I want to know. I want to know how you guys are, coping, because I know trading is not easy. To learn it is not easy. There are lots to learn. All right. There are lots to learn. I cannot give you everything, but the basics, what you need to know, is what I'm giving you guys. After this course, then you can now start improving yourself by practicing it. As you are practicing it, you will be learning more as you progress. That is how it is. Risk management. Risk management is the process of what? Identifying, assessing, and controlling potential losses. You identify, you assess, you control what? Potential losses. Because when you click buy or you click sell, if you make any mistake, that mistake will cost you. You know the cost? Your capital will be drained. That's why you see people blowing their account, blowing off their hard-earned money in 1 minute or maybe 1 day. Yes, because why? They lack this application of risk management. The essence of risk management is to control, is to identify, assess, control your potential losses, is to control your losses. And greedy people always shoot themselves on the leg. You want to be greedy. You don't want to take one step at a time. You want to you just see a setup, you just use the whole of your account. Because why? You want to just flip your account from 1,000 to 10,000, to $10,000 once. It does not work that way. Even if it does sometimes, but no, it's a wrong thing to do. Take it step by step. Give yourself a target. Between now and December, I want to take my $1,000 to $2,000. So by so doing, that time period, you trade with caution. You are not in a hurry. You just trade in a very smooth and cool way. You don't rush because you want to flip. No, you take it easy. You take it easy, step by step, as you continue to grow your account. That is how it is. All right? So it involves using tools and strategies to protect your capital, limit exposure. The way you expose your account, your capital, you limit it. You use tools, you use strategy to protect your capital, limit exposure. And then once you are able to do all that, that will ensure long-term survival in the market. Because some people, they will open an account before 1 week, they blow it. They will open another one before 2 days, they will blow it. Why? Because they are in a hurry to flip their account. They are in a hurry to buy big motor. I don't know who you are trying to prove a point to. As you can see me, I've been trading. I don't even show you guys my account, what I make, no. It's none of your business. It's none of your business. I know trading. I trade. All right? I owe you nothing. I cannot be showing you what maybe my trades or what I make. No. I don't owe you any explanation. No. If that will stop you from following me, yeah, I don't bloody care. As the spirit leads, just learn like now. It's a decision I took upon myself. I said, okay, let me teach people. All right. That is why I'm teaching you. All right. That is why I'm teaching you guys. I cannot be showing you my lifestyle. Yes, most people do it. That is their own, but definitely not me. All right. I am telling you, as a trader, you need to apply risk management. It's just like a caution. Caution, knowing fully well that To make money in financial market is not overnight. All right? Trading is not a get rich quick scheme. You don't want to get involved in trading because you want to get rich quick. No, it takes time. You first of all learn it. Focus on the process. Focus on the process. Acquire the skill, the knowledge as you grow. You just see yourself making the money that you'll be struggling for. That's all. So it involves using tools and strategies to protect your capital, also to limit exposure. And when you do, that will ensure long-term survival in the market. Then, in a simpler terms of risk management, it is how you make sure one bad trade does not wipe out your trading account. I've given it to you. If you don't understand it, watch it 2, 3, 4 times, it will sink. Only one bad trade can wipe your account because you want to flip 1,000 to 10,000 immediately. And what happened? You now use your whole account, all right, for just one trade. People do it and they succeed. Does that mean that you should do it? Before they succeeded, do you know how much they have lost? You don't do like that. It takes process. If you want to build a house, it takes process. You have to set up the foundation first. You get the plan and all that, set up the foundation, and it's the foundation that will determine whether you want to build an upstairs, 2-story building, 3-story building, and all that. You have to know from the beginning. Then once that one is done, then you now start raising the structure. First of all, you build the foundation. All right, it's like that. Gradual process, step by step, you are just going. It's the same thing. Because once you start any discipline, all right, any field, you won't understand it first. At first, you won't understand it, but the more you go, you'll be getting the understanding. The more you go, you'll be getting the understanding. And before you know it, everything will just be clear to you. That is how it is. So the core principles of risk management. Number one, know your risk per trade. You must know your risk per any trade. Know your risk per trade. Limit each trade to 1 or 2% of your account balance. Even sometimes 0.5, half of 1%. Even me, sometimes I use 0.30. Yes, that is it. I'm telling you the truth. You limit it. All right? And don't go above 2%. If you go above 2, can you imagine your account size and maybe your account balance? You don't want to take only one trade. You are using 5%. You are using 5%. Right? You are using 5%. So if you now lose that one, how many trades do you think you'll be able to take before you blow your account? So instead of dividing that one into small portion, then you take, as you take a trade, even if you lose the trade, it will not affect your capital too much. But because of you have lost, you now go back and look at what you did not do well and you are learning. That means once you lose that trade, you learn from that mistake, then that mistake will not reoccur again because you have learned from that. But if you now blow your account and you now learn from that silly mistake, there is no opportunity for you to trade again because you don't have money in your account. That is what we are saying. As a trader, sometimes you lose trade. Once you lose a trade, you now go back and reanalyze it, look at what you did wrong, why the trade did not play out. You have learned something and it will not happen again. So it's like that. Sometimes it might just be impatient. Impatient. That's why I tell people you must wear a garment of patience and take away emotions when you want to trade so that your head will be clear when you want to make decisions. All right. That's why you have to analyze trade and stick to your rules. Anything outside your rules, no, you don't do it. All right. So you limit each trade to either 1 or 2% at most. Even sometimes 0.5 of your account balance. The next one is, for example, if your account is, maybe your account balance is $1,000, risk no more than $10 to $20 per trade. You see how it is? Because each pip has a cost. Each pip has a cost. And it now depends on the asset you are trading. So you know. All these things you must know before you place a trade. But most people don't know all these things. They are just trading blindly. Number two is you use stop loss orders religiously. Use your stop loss order religiously. Remember, I taught you guys what stop loss order is all about. It helps you to protect your capital. Now, a stop loss order automatically closes your trade if the market moves against you. It's an instruction to your broker. I've done my analysis and I've placed my trade. My TP, I've placed it. That is my take profit, I've placed it. My stop loss order, I've placed it. My anticipation based on my analysis, this trade should go my way. But should anything happen, take me out from this level. That is a function of stop loss. Most people still trade without a stop loss. And of which immediately you place your entry, the next thing is stop loss. Because as you are placing your entry, and in fact, anything can happen. The price can even turn immediately, and you will see a very sharp push to the downside. If you don't quickly place your stop loss immediately after your entry, it will drain your capital. You don't play when you are trading. Before you even enter, you know where your stop loss should be placed. So as you click enter, you just put your stop loss in place immediately. All right? So it will protect your capital, close your trade when the market moves against you. Another point is that it protects your capital and removes emotion from decision making. Because once you have done all these things, you know your risk per trade, you know your account size, okay, this is the lot size I'm supposed to use. You put your stop loss, you know your stop loss pips, how many pips you are supposed to give. If it's 2 months, then you can still place your trade, but what you need to do is to reduce your lot size. Okay. As we progress, you will see everything. Then, once you are able to do all that, you leave the system to do the rest. Remove your mind and just go and be doing another thing. Once in a while, if you have the time, just check and see. Check structure. No matter your analysis, once in a while, check structure. Check structure, because once you see something that is going on there, it now gives you a change of character or a market shift, just know that it's supposed to be coming down now, out of the trade. Don't stay there and be praying. No, it doesn't work. So, number 3, set take profit target. All right? Set take profit target is very important. Like I've told my guys, always target the resistance level, that is the previous high. The previous high should always be your target. If you are a beginner, once there's a break of structure to the upside or a break of structure to the downside, now a break of structure to the upside tells you that the price is increasing, is bullish. As it's coming down at the point of reversal, all right, that is the high at that moment. Price will now start reversing back. As it's coming down, all right, let me show you guys so that you see this one here right now. Price has done this. One moment. Price has done this like this. It got here. This is a high. This previous high has been taken out. That is what we call buy-side liquidity. This push has taken out this buy-side liquidity, and it now use this to fuel the push to the upside. Now the price is here. This is a resistance where who stays at the resistance? Which trader stays at the resistance, guys? If you know the answer, please drop it at the comment section. Now, this is the resistance, all right? And this is what we call turning point. All right, now we are expecting price to make a pullback to either test this level before push to the upside. All right? As a matter of fact, I am patiently, now you can see the neckline has been broken. All right, this buy-side liquidity has been taken. All right, this one now has been taken. So I'm waiting for a pullback. Once this pullback is finished and I see any hesitation and a push to the upside, I will just place my trade. I've been waiting for this thing since yesterday. This is Euro USD. I've been waiting for this setup here now since yesterday. So you understand now what I'm saying. Once it push to the downside and I see that the retracement is over, as it starts going up, then this level now will now be what? The buy-side liquidity. All right, this here now will now be the buy-side liquidity. Once this price pull back, once it's done pulling back, the aim now will now be that it will now push again to the upside to go and give us a higher price. Do you understand? So what I'm saying in effect is that if it pulls back to this level, if you don't want to struggle at all as a beginner, target this high. Once price push as it's going up, it's going to take out this buy side liquidity to create a new high. All right. If you are now very perfect, you are now very professional, you know that, okay, this move will get to so level. Then you now place your trade and allow it to run for 2 days, 3 days, maybe 1 week before you take your profit. Do you understand? But as a beginner, you might not be able to have the patience to hold the trade. If you see that the trade is pulling back like this, now oh, it's coming back. No. You can imagine if you had entered from here, you see where the push now get to. In between, you see some pullback, pull back, push like that. But if you see, let me show you so that you understand. This is the main push, pullback, push. And now this buy side liquidity has been taken. This buy side liquidity has been taken, push to this side, pull back. All right. After this pullback, now as it's going up, this is a target. It needs to push, take out this buy side liquidity, push to this side. If you enter from here, you just allow it to run until this leg is taken, is violated. That's what I mean. Now, let me show you how many pips so that you will understand. From here now to this point, how many pips? 486 pips. You see? From here to this point, let me show you how many. 761 pips. It's not just one day. It will take time before it will get here. Remember, this is daily time frame. It will take time, maybe 1 week, 2 weeks. All right? So that is how it is. And even this pullback, look at it. From here to here. I mean, 443 pips. All right? And once you see this kind of movement now, change of character to the downside. All right? This push, it did not take out this high. It now tells you that once it created this lower high, it tells you that this price is heading down. As simple as that. You see, it's now coming down. It now got to this point. It now stopped. All right? Then it now started pushing to the upside. It started pushing to the upside, taking out this leg. All right? So what we should be expecting now is for this pullback to be exhausted. Once this pullback gets exhausted, then the next push, I'm going to join. I've just told you my analysis. I'm going to join to push the market to the outside. It's as simple as that. As simple as that. And once it gets to a support level, if that place holds, as it's pushing up, this guy will have to give way. He needs to go and take out this leg. That is how trading works. All right. So that is how it is. Now, let's continue. So you set take profit target. Now, lock in profit at predefined level. This take profit will lock in your profit at a predefined level. That level you chose, because I told you guys, take profit is an order. It's an instruction given to your broker. Once I'm in profit and it gets to this level, take me out of the bank my profit and take me out of the trade. I'm okay. So that is how it is. A lock-in profit at a predefined level. You'll be the one to choose where the level you want price to get to before your broker will now bank your profit for you. And I told you guys, always target the previous high in terms of a bullish trend. In terms of a bearish trend, target the previous low. All right? Because if it's bearish, the previous low is now going to be a weak low, as a strong high from the resistance is coming, is going to take what we call sell side liquidity for it to create another lower price. After the creation of another lower price, there will be a pullback. As simple as that, guys. This keeps you from getting greedy and helps maintain discipline. When you set your target, you make your entry, you put your stop loss and set your target. You have fulfilled after a proper risk management, knowing your risk per trade, knowing your account size, and you know your position size, all right? That's your lot size. Then you know your risk per trade. Then you know how many stop loss pips you need to give, because that is what will determine your lot size, all right, to stay in the line with your risk management. Once you have done all that, you have fulfilled all righteousness, and your top-down analysis is in place. Your market structure, you have been able to mark everything. You know where the trend is headed. Leave the rest for the system to do. Take away emotions. That will help you maintain discipline. Once you do it consistently, you just say, "Ah, this thing is so easy." Yes, it's so easy, but the beginning is very difficult. It's more difficult when you are doing the wrong thing. I tell you. So the fourth one is leverage wisely. High leverage is equals high risk. Use low leverage like 1 to 10 or less until you are consistently profitable before you can now start saying, I want to use a high leverage and all that. As a beginner, I beg you, or rather I advise you, because begging yourself is not supposed to come to play. Because if you lose your capital, your hard-earned money, you will learn in a hard way. So I'm just telling you, clearing your mind. Remove out your mind from that thing you want to buy overnight. Remove your mind from trying to, okay, I want to show off. Oh, that is why the reason I want to go into trading, I want to make money fast. No, remove your mind. It does not work that way. Just like you staying out and people are playing football, you think it's easy. But go in there and run for 90 minutes, you discover that it's not easy to even run. All right? You'll be outside the field, you'll be making money. But if you go inside, if you are the player, you discover that it's not easy. All right? So it's like that. Then what 1 to 10 leverage mean? What does it mean when you say 1 is to 10? You know, all those things, you need to know that that is the education. You need to know all those things. So when you see that a broker will say, oh, I offer 1 is to 100, 1 is to 50, 1 is to 30, depending on the broker. Yes, it's okay. But high leverage is equals high risk. All right, low leverage is equals a lower risk. All right, if you are using a low leverage, you have a low risk. If you are using a high leverage, you will have a high risk. So one step at a time. If you're not a professional, you now say, okay, this thing I cannot. It will get to a point, you know, this thing I know now. I don't strong for this level. Once you get to that level, yes, you can use any leverage, even if it's 1 is to 100. What it means is that for every $1 you invest, every $1 you have in your account, you can control $10. That is 1 is to 10. If nobody has taught you before, I am just teaching you now so that you understand. Once you see 1 is to 30, 1 is to 40, 1 is to 50, what is all this? I have just given you the solution. This is how it is. For every $1 you invest, you can control $10 worth of that asset. If you deposit $1,000, you can trade with 10,000 in market exposure. That is what it means. It's very clear. I make it very clear for you to understand. I'm not speaking grammar. All right? If you deposit 1,000, you can say if I deposit 500, you can control 10,000 or 5,000 worth of asset, all right, in market exposure. While it is considered low leverage, compared to high leverage ratio like 1:100 or 1:500, 1:10 is more conservative because it has a low risk. It reduces, because now if you say 1:100, all right, that means for every $1 that you have, all right, for every $1 let's calculate it. Let's say 1:100. I'm just giving you so that you know. 1 times 100. So you have $100. You are controlling $100,000. Eh? You now have $100,000 market exposure. All right? $100,000 market exposure. If it is 1:100, then that $100,000 market exposure, if you make any mistake, your risk is higher than somebody who is using 1:10. All right? Do you understand? If I have 100,000 market exposure, you have 10,000 market exposure, we don't have the same risk. All right? If should anything goes wrong, because in fact, there are times that things will go wrong. Let's be sincere to ourselves. If you take any wrong move, you pay for it. That is the truth. Let's say you are driving on the road. If you make any mistake, you cause an accident. Either you hit somebody or somebody will hit you, or you go and hit the pavement. It's an accident. Most accidents you see on the road is not caused by that same person. It can be caused by another person. So if you make any wrong move, you do know what will suffer? Your capital will suffer. You'll be out of business. If you don't have capital, how can you do business? So you have to know how to protect your capital. That's why I tell you this topic is very, very essential, very, very important. The way this topic is important is the same way that topic of how to read market structure is very, very important. You need to know how to read market structure. Just like somebody who wants to go to school, you don't know how to read and you don't know how to write. How is it possible? You don't know how to read and you don't know how to write. How is it possible for you to now go to school? You have to now go and learn how to read and write first. So that is how it is. So that being said, it's very important for you to know how to read market structure and also for you to know how to do or carry out top-down analysis. Charles, for you to know how to carry out your top-down analysis. So ideally because it reduces the risk of large losses from small market moves if you are on a low leverage. All right, ideal for beginner or anyone focused on risk management and long-term sustainability. It's very, very important. You must know how to manage your risk and be careful with all these leverage. All right? He has his own bad side and he has his own good side. So, number 5, risk to reward ratio. Aim for a minimum of 1 to 2. risking $1 to make $2. Now, once you say risk to reward ratio, simply means once you place your trade, your target level where you place your TP, the distance between your entry to your take profit level should be twice as from your entry to your stop loss. If your stop loss, your entry to your stop loss, let's say for example, if your entry to your stop loss is 10 pips, all right, then your entry to your target level should be 20 pips. That is risk to reward ratio. That is 1:2. All right. If your entry to your stop loss pips, the number of pips is 50, that means from your entry to your take profit target where you want your profit to be banked should be 100 pips. That is 1:2 risk reward ratio. That is what we meant by 1:2. Mathematically, if you are risking $50, all right, you want to gain $100. If you are risking $100, you want to gain $200. The reason is that this ensures that even with a 50% win rate, you still stay profitable, because any trade that you take, if your take profit is always 1:2, that means if you are risking $10, you are gaining $20. Now, let's say you take one trade, you hit your take profit, you have $20, for example. Let's keep it okay. Let's say you take a trade, your take profit is 200. All right. You now hit $200. You have $200. You take another trade again, you lose the trade. All right. What happens? You lose $100, you still have $100 extra. You take another trade again, it's 2:1, then you hit your take profit, then you now have again $200 plus the $100 that is remaining, that is $300. If you now take another trade, another time, you now take a stop loss, maybe something went wrong and you get stopped out, you lose $100, you still have $200. Can you see why 1:2, the risk to reward ratio is very, very important? So you need to stick to that, even though, because this will ensure even if your win rate is at 50%, you will still stay profitable. As simple as that. If you don't understand, watch this thing time without number. One moment. Sorry about that. So if you don't understand, watch it again and again for you to get the understanding. That strategic tools and techniques. Now we have the tool, all right? We have the purpose, and here is the tips. Position sizing, all right? Position sizing, this is what? It controls how much you trade, all right? The tip is that use calculators to stay consistent. Now, there are position size calculator, all right? Where once you say position size calculator, go to Google and type position size calculator, then all you need to fill in is the number of pips the number of your stop loss pips, your entry, that is your entry price, and all that. It will just calculate it for you. Yes, it's good, but it is also good for you to know how it is being calculated. All right? It's not just about the system doing everything, but you should have the knowledge. Why this come to play, you should know. All right? You can do it yourself. You can just go download position size calculator, put it on your desktop. So anytime you want to trade, you just quietly type in as you, okay, this is where I'm going to put my stop loss. My stop loss is going to be 50 pips, it's going to be 40 pips, it's going to be 30 pips. As a matter of fact, it's never going to be the same. All right? It depends on the structure. All right? So once you type in your entry, your stop loss pip, it will just calculate everything and it will tell you the lot size you are going to use for you to stay consistent to based on your risk management or risk tolerance. All right, based on your account size as well. All right, so there is what we call calculator. All right, position size calculator. Then another thing is trailing stops, because we have the strategic tools and techniques to use to also manage uh, to also uh, uh, to also manage our trade. All right. So trailing stops. All right. These protect profits as price moves. That trailing stop there, you adjust as trade moves in your favor. Now, the trailing stop is different from stop loss. All right. What this one does is that you can set it. You say, okay, once the trade moves uh, in my favor, if it moves in my favor, now once it moves 20 pips in my favor, the trailing stop will move to that level. All right. That is where you now have your stop loss, original. If you move again 20 pips in your favor, the trailing stop will now move again. All right. And once your trailing stop moves, your profit is already bound. Your profit is already bound. So price cannot just come back and take those profit anymore. Automatically, once your trailing stop moves, adjust. It's you that will set it. If you say move after 10 pips, it will move. If you say move after 5 pips, it will move. If you say move after 20, 30, 40, 50 pips, it will move based on your settings. All right? But it also has a bad side. The bad side is that if you say move after 20 pips, it will move to that level. All right, after 20 pips. Now, if there is a little fluctuation from price to just reverse back with the intention of just pulling back, then before pushing to the upside again, before resuming the underlying trend, it might just stop you out and you are out of the trade. So it's different from the normal stop loss, because that normal stop loss is static, is there. Where you put it, it will remain there until you manually move it, adjust it. When we now start treating trade management, how you manage your trade when you are on a particular trade. All right, I will teach you that way, how you can manually, once the trade moves in your favor, how you can manually adjust your stop loss. All right, it's different from trailing stop. All right, you can also manually adjust to lock in profit. Yes, you can do that, but the trailing stops moves automatically once you set it, do the settings. All right, then Diversification. Spread risk across peers. Avoid overexposure to one currency. You know, when you diversification simply means you invest on this, invest on this, and invest on this. Now, if you have been reading book, you know that cash flow quadrant would tell you that the successful people in business, they don't even diversify. Rather, yes, they do diversify, but they really concentrate on one particular thing and get that thing done before they start diversification. All right, focus on one first, get it done. Then you can now move to the other one. Not starting this, starting another one like that. No. As a beginner, you know that your target is to get one pair. Focus on that one pair. Use that pair to learn. Learn that pair, how that pair moves, how it pull back. When it pull back, how deep is it? When it wants to push back, how deep it will go. Then this, if you want to push, then how far it can go, the range, all those things you need to learn them. All right? Because if you are jumping today, you trade this, tomorrow you carry another pair and trade. Next tomorrow you will not be able to know how they move. You take one pair, choose one pair as a beginner, choose one pair and study it, learn with it, master it. Then later you can also let me analyze about 2, 3 pairs. Anyone there is an opportunity, I trade. Then you now have idea how pairs move. All right, not that you are just a beginner, you open trade here, open another trade, open another trade. No, don't do that, please. Don't do that. Trading journal. This is very, very important. It track wins. Make sure you use your trading journal, track wins, losses, and emotions. Learn from patterns and mistakes. It's very simple. Trading journal can be anything. It can be you buy book or you open an Excel. All right? Open an Excel. Open an Excel. Then any day you type pairs, type date, pairs, then lose or win, you can put it, all right, lose or win, title it, all right, then you start filling it. Number one, you take a trade, which pair, you write it. And entry price, you can put it, stop loss pips, how many pips, you can write it, all those things, put the headings, stop loss pips and all that. You create your own. No one is perfect. Create your own. Then all you need to do, what is important is that any trade you take, write a pair, all right? You can even write the time it takes for the trade to be executed, for you to hit your take profit. You can do anything with your trading journal, all right? Put the subheadings, then you write the pairs, all right? You write the pairs that you trade on that day, then how many days it takes you for you to hit your take profit, you can put it. Then at the end of the day, that is the entry price, the closing price, you can put it. Then at the end of the day, your lot size, okay, put your lot size, all right, the lot size you use so that you know that you'll be consistent. Use that lot size. Then when you use lot size, how many pip did you use? Then at the end of the day, when the trade plays out, if he wins, you write win. If you lose, you write win. Don't be biased. Be truthful to yourself. All right, this use it to track both the trade you lose and the trade you win. Then apart from that, your emotions when you were trading, how did you feel? Your reactions. What were you thinking? How did you react when the market is pulling back before it resume again? All those things. Write them. Just write them. Just be truthful to yourself. Keep populating it. All right, create a table on Excel and keep populating it. That is a journal. Once in a while, you go there, go through it and say, okay, by so doing, you are tracking your progress. All right? Learn from patterns and mistakes. If you make any mistake, if you lose any trade, go through it again and see, okay, oh, this is what I would have done. I wasn't supposed to do this. Okay, I enter from here. Okay, maybe I was little in a hurry to place my trade. I would have waited a little. So you are learning. And all those things you now discover, you write it, populate it, make sure you write it on your trading journal. That's all. Before you know it, you have a long list of information that you can always fall back on. And at the end of the day, you'll be able to even pass the knowledge to another person, just the way I'm doing today. So as simple as that. The next one is what? Psychological mastery. Stay emotionally detached. All right? Don't chase losses or revenge trade. It's very, very dangerous. When you lose a trade, I tell people, once you place a trade and it did not go well, stop for that day. Don't trade. Forget it. Even if you see a very nice setup, that day, forget trading. I'm telling you. Because any decision you are making after losing a trade is what we call revenge trading. Because you want to get that money back. And by so doing, you will lose more money because you will make a very rash decision that is not supposed to be. You will not even have the time to really put your eyes down to analyze the market. You just, okay, since it's coming down, it needs to go up. No, you won't even have time to think clearly. All right? So that is what we call revenge trading. Don't ever do that. If you lose a trade, the thing I would advise you to do is take that trade and analyze it. What happened? So that when you see that kind of pattern tomorrow, you know what to do. Stick to your plan. By so doing, discipline beats excitement. Don't be so excited when you are trading. It don't, even if you win, all right? If you hit your take profit, don't be so excited. If you hit your take profit, I tell you, I always tell guys, take that trade, analyze it again, look at, okay, this is what happened and this is why it plays out. Learn from it. All right? Stay disciplined. All right? And make sure you stick to your plan. Don't just say, okay, I've been doing this, I want to flip now. No. Take everything one step at a time. Accept losses. They are part of the game. Manage them, don't fear them. When you place a trade and it hits your stop loss, anytime your stop loss is hit, you are losing money. That is the truth. So once that happens, just know that they are part of trading. You manage them, be able to say, okay, accept them. This is just the way it is. Because in business, sometimes you lose, sometimes you break even, sometimes you lose some, sometimes you break even, or you make profit. Three things happen in business. So manage them well, don't fear them, learn from them. That is the most important thing. Position sizing formula. Position size, risk per trade, stop loss in pips or points, pip or point value, all right? Because each pips has a value, but depends on the asset, all right? Breakdown of terms, risk per trade. Now, how much you are willing to lose, that is a risk per trade. Anytime you want to place a trade, ask yourself, how much am I willing to lose from my account. Now, for example, 1:2%, meaning 1% or 2% of your total account. How much am I willing to lose? Do I want to risk 1% or I want to risk 2%? Ask yourself this question before you even start. All right. As you do your analysis, you see an opportunity. Ask yourself, how much am I willing to lose from this on this trade from my total account? That is my capital. Remember, once you're out of capital, you are out of business. Stop loss in pips, all right, or points. Every movement in trading is what we call pips. If you don't know, go back and watch those videos. Pips is what we call price interest point. It ticks. As it ticks, it has a price. All right, if it ticks against you, you are losing. If it ticks in your favor, you are making money. And each tick has a price. All right, it has a price. That is distance between your entry and stop loss. You must know that. You must know what is the number of pips. It's very important. The number of pips is very important. Like I told you, if you have done your analysis and you now see that, okay, there's an opportunity here, the first thing, your entry. You know where your entry should be. Then the next thing you should be thinking of, my stop loss to protect my capital. Then once you are able to identify, okay, this is where I will put my stop loss, what is the distance between your entry to your stop loss is very, very important. That is what will now determine the lot size that you are going to use. Pips point value. The monetary value of each pip or point depends on asset and lot size. I've already told you guys. Example, let's say account balance. Let me give you people the scenario now. Let's say your account balance is $5,000. Now the risk percent is equals 2%. You say you want to risk 2% from your account. Example, like I told you guys, sometimes you risk 1%, sometimes 0.5, sometimes 0.3, sometimes 0.2, it depends. Let's say from here, your risk percent is 2%. You want to risk 2% from your total capital. That is what it means. Now, you say risk per trade is equals 100, right? How did we get that 100? I want you to follow me. Okay, before we go, let's just go through it. Risk per trade is equals $100. Now, I know you want to ask, how did you get $100? Don't worry. Stop loss is equals 50 pips. Price value per pips is equals $1. All right? This is how it is. Now, let me explain where. Your account balance is 5,000. Your risk percent, you say you want to risk 2% of your total capital. What is the capital? 5,000. Risk per trade will now be 100. And that trade you want to play is the risk that is involved is 100. That is the risk per that trade is going to be 100. Now, how did you get that? How did we get that 100? You now say, you say 2 divided by 100 times 5,000. What does it give you? Carry calculator. Just type 2 divided by 100 times 2 divided by 100%, 2% divided by 100% times the answer times 5,000, that is your account size, it gives you 100. That is $100 is your risk per trade. Then it does not end there. Now you now say stop loss is equals 50. If you are using the entry between your entry and your stop loss, if the pips is 50 pips or 30 pips or 20 pips or 15 pips, the lower the pips, all right, is better. Otherwise, the higher the pips, that means you have to reduce your lot size to match for you to be able to still risk. If you lower your pips, that means you are not going to use 2% of your total capital for you to still stay with this 100. There are ways to do it. That is why you need to learn how to use this. You need to learn the formula, how to calculate it. And that is what I'm giving you for free now. Now, in this case, you are risking 2% of your capital, and your capital is 5,000. Now we have risk, we have divided, we are now say 2 divided by 100 times 5,000, that is 100. Now you are risking 100 per each trade. Now your stop loss is equals 50 pips from your entry to your stop loss, 50 pips. Now the pip value, like I told you, the pip value, each asset has its own value, has its own pip value. Now, any asset you are trading, just go to Google or anything, type what is the pip value of this asset. All right, it will show that. From there you will know. All right, from there you will know. Pip value is equals, let's say for example, pip value is equals $1 per pip. $1 per pip. So 1 times 50, that is, it will be $50, right? It will be $50. All right? It will be $50. That means from your entry to your stop loss, that means it's $50. Now, this is the calculation. Position size, all right? That is position size, all right, is equals 100. Why? Because you want to risk 2% of this 5,000. And when we say 2 divided by 100 times 5,000, it gives us 100. So the position size will now be 100. That is, you are risking 2% of 5,000. That is 100. You divide it by 50. 50, what is 50? 50, where did you get the 50? 50, we got it from the distance between your entry to your stop loss. Is 50 pips that you give, all right? You get 50 pips, so 100 divided by 50 times 1. Where did we get this 1? The pip value. Each pip that makes up that 50 is $1. Down, you now say times 1. You now say equals 2 lots. You have to use 2 lot size. All right, 2 lot size. You would trade 2 mini lot if $1 per pip is equal mini lot to stay within your $100 risk. As simple as that. Anytime this guy is reduced, you have a better chance, all right? You have a better chance because once you reduce, this one here now will no longer be 50. You will now have a better chance to, like, maybe use 2.5 or 3%, but it's not advisable. Anytime this guy is reduced, that means you are less exposed to risk. So what you should always be looking out for is your account size, the percent you want to risk per trade, and your stop loss pips. Your pip value, you go to Google, just type pip value of Euro USD, it will tell you. Pip value of SAUU SD, that is gold, it will tell you. Any instrument or any asset you are trading, before you do that, just check the pip value so that you can simply work out your position size and you know the lot size you are supposed to apply. As simple as that. Guys, I don't see anybody that can break this thing down more than the way I just did it. This is how it is. You must know your account balance, know the percent you want to use, you want to risk. If it is 1%, if it is 1% from here, for example, you know that this one will now change to $50. How is it going to change? Let's do the mathematics. Like I told you, you say 1%, you want to use 1%, 1 times 1 divided by 100 times 5,000. How much is that? 50. That means what your risk per that trade is 50. Is $50 instead of $100. That means if you reduce this one to 1% of your account, you'll be risking $50. All right, you'll be risking $50. Let's say if you reduce that one to 0.5 divided by 100 times 5,000, you see, you'll be risking $25. You'll be risking $25 if you use 0.5. So it's like that. And apart from that, your stop loss peak, you must know it. It's very important. From your entry to your stop loss peak, where you want to put your stop loss, you must know it. And once you are able to know all those things, the next one is you go to Google and ask Google, this instrument I'm about to trade, what is the pip value? It will give you the pip value. You just know the pip value. Okay, if Euro USD, the pip value is $10, you know that it's $10. If it's going against you, you are losing. Each pip that is against you you are losing $10. Each pip that is in favor of you, you are gaining $10. That's the movement. You need to know the movement. All right. So from there, you now know, okay, this is the lot size I'm going to use. This is the pip move. This is the stop loss distance that I'm supposed to use. From there, you can also, okay, if you want to stick to always 1%, stick to always 1%, and you now say, okay, this is how to build the rules. All right. You know, say, okay, I want to be using 1% of my account. All right. From to be using 1% of my account, that means if my account is 5,000, that means this one here will now be $50. Okay. My stop loss distance from my entry to my stop loss, I don't want it to be more than 30 pips. Now, any trade that you want to enter, if the stop loss is above 30, you have the right to stay out. That is how to stay disciplined. That is how to set rule-based strategy. Any stop loss distance that is above 30, I don't want to be involved. It's your own, you can do that. And that keeps you more disciplined and for you to have a rule-based strategy. Simple. So you stick to 1%. This is what I'm going to be using. Or if you now say, okay, instead of 1% that you normally use, and the distance of the stop loss to your entry level is now 35. What you need to do is reduce your lot size. Instead of 1%, you can put 0.5 for you to still stay within the risk per trade. So guys, I have explained to you guys, and it's as simple as this. Why this matters? As someone trying to build your account, mastering position sizing helps you to trade with discipline. It helps you to avoid emotional decision, helps you to preserve capital for long-term growth. Guys, thank you so much. At this point, I would say I thank you guys if you have followed me up to this level, and I know I'm very confident that you have learned a lot. You have learned a lot. This is power packed. This is something that if you know it, watch it very well, not more than one, not once, watch the video second time, third time, have the patience to take note and follow it to the end. I tell you, as you do, you are just on your way to become a professional trader. I tell you, 3 things you must learn: how to read structure, all right? Then how to do your top-down analysis. Then the next one is risk management. All right? Risk management. I'm going to teach you about trade management, how you'll be able to manage your trade. And that one is also important. All right? Once you have placed your trade, you don't just go and sleep. You need to manage it. All right? It's very, very important, guys. So thank you so much. Please drop your comments. If you have been getting value from this channel, please drop a comment. I want to see your like, I want to see your comment, and I want you to please subscribe to my YouTube channel. This 1-month training course that I'm giving you guys, I'm telling you, is for free. So please subscribe, share, and on this note, I say thank you so much. God bless you all.